Today's episode is brought to you by S&P Global Market Intelligence. Find insight at every data point with enhanced S&P Capital IQ Pro platform. It's the leading data solution for strategics and investors alike. Discover critical data sets, including coverage of over 54 million global private companies, plus AI-powered tools to streamline your workflow. It's no wonder 85% of companies in the S&P 100 are clients. Learn more at spglobal.com/proinsights. That's spglobal.com/proinsights. Hey, M&A scientists. Let's talk about one of the biggest time and cost sinks in deal making, contract review. Every deal comes with a mountain of contracts, employment agreements, customer contracts, vendor contracts, you name it. Buried within those hundreds of pages are crucial details like change of control provisions, consent clauses. Those are the things you need to get ahead of. Traditionally, combing through these contracts takes hours, sometimes hundreds of hours. But what if we could reduce that time by 80%? With Dealroom AI, you can. Our AI-powered contract analysis tool scans and extracts key information from all your contracts in minutes. No more spending countless hours hunting for risks. Dealroom AI highlights critical clauses instantly. And here's the best part. It's incredibly easy to use. No special training, no steep learning curves, just upload your contracts and let Dealroom AI do the heavy lifting. Think about the legal fees you'll save and the efficiency you'll gain. Plus, computers tend to miss less than humans, so you can trust you're catching every important detail. If you're ready to revolutionize your contract review process, check out Dealroom AI. Because in M&A, time is money. We're here to save you both. Visit dealroom.net to learn more. Here's to the deal. Hello, M&A scientist. Welcome back to the M&A Science Podcast. I'm your host, Kison Patel. Today, we're diving back in with Adam Coffey, founding partner at Chairman Group, for part 2 of our episode on building your M&A empire. In part 1, Adam laid out his foundational M&A strategies. If you haven't listened, check it out in the show notes. Today, Adam has taken us further with advanced strategies, covering how to evaluate acquisitions, the importance of strategic alignment and cultural fit, and using financial instruments to structure deals effectively. Let's jump in. So you mentioned proprietary deals are pretty clutch to all of this earlier. I want to learn from you. How do you go about doing proprietary deals, cultivating that relationship, getting that level of interest or getting somebody interested that may not have been thinking about the selling the business? Then we'll get into like negotiating and creating a structure to win.
So let's just first say, for those listening out there, do you have time or do you have money? If you have money and don't have time, I hire what's called a buy-side advisor. And a buy-side advisor, I give them my buy box or my avatar of what I'm looking for, and it's their job to go out, build a funnel, find a bunch of companies, bring them in, and do some early qualifying of the companies to this person's willing to have a conversation, it meets your avatar, and then they bring it to me. They bring it to the company. So every time I go into a company, I hire a buy-side advisor. I also hire a VP of business development in-house to run the process with that buy-side advisor. But that truncates time. So I pay to have this funnel built for me. But if I don't have money and I have time, I have to build a funnel. And so I need a tool. And there's a lot of tools out there. Most of them are sales software tools. So I'm a salesperson and I need to know every company in my industry that's a potential client. And I'll mine those kinds of software to build kind of the top of my funnel. And so I might use like Dun & Bradstreet, a tool that they've got, called Hoovers, D&B Hoovers. Yep. Or I could use Grata. Grata's a good one for this, but Grata costs 18 grand. Dun & Bradstreet Hoovers cost 600. But Dun & Bradstreet Hoovers, I still have a lot of manual legwork to peel through the onion to get to what I need. Grata kind of does it for me, but it costs more. So again, time versus money. If I've got time and no money, so
if you got no money, just use Google.
Yeah, exactly. Hire some college kids, on summer intern projects to build me a list of companies, that meet this criteria within a certain, geographic reach. And so I've got to build and qualify a funnel. But selling a company is a people. It's a personal transaction. It's not cold. We want to develop relationships with people. So I have to have some methodology of building a list of targets, of potentials. Then I have to have a methodology of outreach. And a buy-side advisor would tell you, I'm going to have to do outreach 6 to 8 times to get somebody on a phone to talk to me. And so, I think that's why I include the personal profile of who's my seller, how old are they, and where would I find them on social media. If they're on LinkedIn, I'm going to reach out to them on LinkedIn. If they're 75 years old, they're not on any social media. I'm going to be mailing something, snail mail, or calling them on the phone, maybe emailing. And so there's going to be different ways I attempt to penetrate. And then I'm going to have kind of a campaign build, just like I would for marketing, to try to find clients. Hey, if I snail mail, it's going to be a 1-page cover with a 1-page slick. And the cover is just a little letter that says, hey, I'm so-and-so, I'm in the industry, and I'm looking for great companies to buy. I came across yours, and I thought, boy, if you've ever considered doing something special, maybe I'm the one that we could do you could do something with. And then I give a slick, which is just a little bit more color around what I'm doing and what have you. And if I'm mailing it, well, I'm going to pay somebody to handwrite the envelope, because if I use stickers, it's probably getting pitched. I don't know about you, but I get the mail and it's like I've thrown out 80% of the mail before I opened anything. And so if it's handwritten, curiosity killed the cat. Someone's going to have to open it because it's like, boy, that was handwritten. That's got stamps on it, not a bulk mail thing. It's like I can get envelopes open, and so I'm doing outreach, and I might need to do it a few times. And you'd be amazed that someone who gets a brochure from me today may not respond today, but they were thinking about selling. And they put my little brochure in their inbox, and then 6 months later, when they had a bad day or they had a health scare, or something happened in the world, and they're just like, yeah, where was that folder or that? And then they call me, out of the blue. And so the best deals I find, I'm not talking price. We have to pay fair market value. I'm just talking, I get better companies. Not ones where the earnings have been fluffed up and adjusted to a point of I can't even recognize the business, and a seller who's not focused on price. It's someone who's been thinking about it casually. And, those proprietary deals, what that means, it doesn't mean I get it cheap. It means if I put in the effort and the work and build a relationship, I get the deal. And if I'm going through a broker's not just talking to me. A broker may be talking to 10 buyers or 30 buyers. And again, it gets back to an auction pretty quick. But I may put time and effort into it and not get it. And so what people want that are buyers, especially PE firms, they want certainty. They want to know that if they put the time and effort in, they're going to get the deal, assuming, that they're paying the fair price and the diligence checks out. And so, I would say that, at maturity in any of the companies that I built, my team sourced probably 1/3 of the deals ourselves. And about 1/3 did come from brokers, but it came from lazy brokers who weren't really building, running a process. They just knew I was buying. And the faster they can find a buyer, the quicker they get paid. So it's like, Adam will pay fair market value. I'll just take this deal to Adam. So I got kind of a semi-proprietary deal. And then literally 1/3 of them came through my website. And if you go to my last company's website, there's a tab that says, sell me your company. Literally. Nice. And for a while, I had a pop-up every time you went to the homepage because my customers never really did web service work. They knew who we were, and we had a sales force. And so you go to my homepage and it would pop up, sell me your company. And I led with it, put it right in people's face. And so about 1/3 of the deals came to me once they knew I was a buyer. And they knew some companies that had good reputations that sold to us, or maybe they had a friend it's like, boy, a third of the deals walked in my door, a third we sourced with a buy-side advisor, and about a third came from brokers, who reached out. And so it's like we have to build a funnel just like getting a customer. I need probably 1,000 companies in the top of my funnel to have 100 that I'm working, at some level to get to, 15 or 20 that I'm actually in good conversations with, NDAs and data flowing, to get the one that I'm going to buy. So it's a process. It's an effort. It takes a lot of work. But if you stay the course and you know what good looks like, you will find them.
Okay, so get the list, really mine through, have your criteria companies, outreach, and then you can get to this first conversation.
First conversation, my goal is to get to lunch, in-person meeting. The first Zoom, I'll call it, or phone call, I'm just establishing I'm essentially regurgitating what I sent out to them, but I'm starting to build a human connection. I'm offering to come see them off-site. Let's go have lunch together. Let's talk about it. We get to lunch. Again, if it's a 90-minute lunch, I'm probably an hour chit-chatting, getting to know them, learning about their life, learning about their interests, their passions, and then at the end, it's like, hey, look, my goal here is to just kind of lay out how this process would work. I'm happy to sign an NDA. Once I do, I'm going to need some basic information, basic financial information. I've got some questions I need answered. You're going to send me that information. I may have a few follow-up questions, but then I'm going to come back to you with a number. And if you like my number, we keep talking. And if you don't, hey, we part as friends because your number may change or my number may change down the road. And so, I'm going to be building in this industry. I'm going to be buying companies for a long time. Let's just stay in touch. Things may change. And so that third meeting now, so first meeting, get to lunch. Second meeting, I want to lay out the NDA and I'm going to need data. I get that. Third meeting, I'm bringing the price. That one could be in person. That one could be via Zoom. Depends on the ease. Once I've been in person once, I don't necessarily have to go back in person again. The goal then of the number is to start to get to the framework for the LOI, which would come next. I don't necessarily bring an LOI, letter of intent. I bring the number. Based on everything you showed me, here's what I think the business is worth. I'm still flexible at that point in terms of how I'm going to pay for it. Is there going to be a seller rollover stock component? Is there going to be a seller note? Is it going to be just financing? How am I going to do it? And I may talk about some of those things to get ready for the letter of intent, which comes next. Once I do the letter of intent, most important part of diligence is financial diligence to make sure that the books are accurate, the numbers are accurate. And most of the time, if they're not, it's not that the person is being disingenuous or committing fraud. It's they don't know what they don't know. Their books they're not sophisticated. The books are crap. So no, a PPP loan is not revenue, and no, an ERC tax credit is not revenue. It's not repeatable. So people can make mistakes. Depending on the kind of business, they may be on a cash basis, and they should be on an accrual basis, and a percentage of completion accounting, and just there's a lot of variables. And books are hard for entrepreneurs, and there's many out there who aren't sophisticated, and so there can be noise in the books. So first part of diligence is make sure the numbers are there and they're real so that you can reaffirm price. 90% of my deals post LOI, if they're going to die, they die because the numbers are wrong. And my rule of thumb, plus or minus 10%, I just close. I don't reprice. Minus 10 to 30%, I'm going to reprice. If it's less, if it's more than 30% off, I don't want to insult the seller. And so all I do is I point out, look, we're going to disengage. I want to show you what we found in the books and the numbers. Here's the problem. Here's the error. Let's stay in touch. And the reason for that is when I put a letter of intent in front of somebody and a number, they've already spent it. They've paid the taxes. They're thinking lake house, boat, retirement, whatever they're thinking. And if I come up and tell them they're going to get a 30% haircut, 40% haircut, now they can't buy the lake house. Now they can't do this. And so they get frustrated. And then I don't want to create a bad situation. So I just tell them, look, here's what I found. And if likewise, if it's grown 30% during diligence and they're pressing me for more money, I buy good companies, I pay fair market value. So if they're really growing, and I don't mind paying more, but if it's plus or minus 10, I don't let them work me up and I don't work them down. It's the 10 to 30 where I have to be open to repricing down or allowing some reprice up, especially if diligence is dragged out. But ultimately, I mean, that's kind of some of the steps, in the process
that comes with time.
And I'll tell you, entrepreneurs, the one thing entrepreneurs don't do enough of is diligence. They don't do enough diligence when they're buying companies. And that's how you get stuck with, oh my God, I bought the company and now I need to dump a bunch of money into it because I didn't know about working capital and I shouldn't have let them pull out as much as they did, or, we're
going to come back to that. I got some questions around that. Okay. Let's use our example here. So Deal Room, a lot of people don't know, we actually own a data room product called Firm Room.
Yeah.
I have been cultivating an investment thesis that there's so many data room companies, like 100 of them. There's a lot of small ones that have been around for 15, 20 years that may fit that customer profile of like, hey, I'm looking to just retire. And this is one where we've optimized our business to operate like 85% profit margin. Yeah. I'm like, hey, we could migrate customers, sunset product, or there's a lot of things we could do.
So these are add-ons, Yeah.
So now I want to go back and said, okay, we made the list, right? And I've actually used Grata to do this. Shout out to Grata. You guys owe me a drink for the shit plugs over here. But no, they're actually great, and they've helped build a list of about 100 of these companies. I did the outreach. Walk me through, what should my message be on this outreach using this example? Because you're pretty forward and direct. Is that, hey, I'm looking to grow through acquisitions. Like, give me your
yeah. So first of all,
but probably email people.
Yeah, I'm going to accentuate the positives. So when I'm private equity backed, then I'm going to be proud I'm private equity backed. But when I'm an independent, I lead with that. Hey, so and so. If it's Grata, I know their name. I know their address. It's like I've gotten good information. And so I'm reaching out to them. Wanted to introduce myself. I'm so and so. I am the owner and operator of an independent company in the space. This is my company. Here's the links. And then my slick might be, here's some stuff about me and my company. And I am seeking to accelerate my growth, by finding great companies to help diversify my product offering, whatever the story is going to be. But it's like, but I'm blowing smoke up their skirt too, because I'm saying, hey, I came across your company and it really interests me. You've built a great business and I think there's a potential here to do something special with you. And so I'm going to state, a few things that I think are pluses. I'm in the business. So you're going to be talking owner to owner, business owner to business owner. I'm independently owned. I don't have institutional money behind me. Maybe they're getting calls every day from a private equity firm, or a buy-side advisor, and they're not happy with that. And so they're not turned on to that. So I'm working the fact that I'm not for now, because I'm not owned by PE. So I'm in the industry. I'm an owner. I own a business. Here's my business. I'm looking to expand my product offering. I'm looking to expand my geographic, reach, depending on what my goals and objectives are. I came across your company. It looks really interesting. It's special. I'm thinking that there might be some opportunity here. If you agree, just reach out. And thank you for your time. And I put a personal touch. It's like it's handwritten. It's not bulk mailed with stickers. Because then I'm thinking form letter. If I did open the darn thing, I read it, and then I'm like, you're full of crap. You're sending out 1,000 of these. And so it's personal touch, trying to establish a personal connection, and that's one attempt. And so I might have one variant that I email. I might have one variant that I snail mail, and I don't do them all at once. I send one, wait a few weeks, send another, reach out on social media, reach out on LinkedIn, maybe mail it to the office, personal and confidential, maybe mail it to their house, maybe email, maybe I reach out to them on a social media platform. It's like I come up with what are going to be my 4 or 5 outreach attempts that I'm going to make. I'm tracking it all on your software. Here's my funnel. Here's my list. Here's the people. Here's the attempts that I've made. And it's a process. It's a numbers game.
So that core message is why you, why now? Like your business seems to be a great fit. It's doing great things, blowing a little air in the skirt, right?
Yeah.
And then why now? It's like, hey, I'm looking to grow. We're looking at bringing products like yours, and here's sort of the business case or a high level of that business case.
Yes. And so to give you an example, a buy-side advisor typically will develop a quick 1 to 4 page handout that gets mailed or emailed. They'll also develop a long deck, like a 20-page deck that really gets into the story. This is who I am. This is what I'm building. This is what I'm looking for. And this is why I think you're a potential fit for that. And so then depending on how, snail mail the first time might be 1-page slick with a cover. An email might be both of those. But, no one likes to click on email links, right? So I might also just tell them my website. Here is my website address. So and maybe I build a website too that has similar information on the website. So they can connect with my website. They can look at the brochure, different ways that kind of mix up the messaging, but I'm consistent. Every few weeks, if I haven't heard from them, and I'll tell you, the typical buy-side advisor will tell you that they'll do 6 to 8 outreaches, but they get 80-85% response. It may just be quit, leave me alone, you jerk. But it may also, eventually it's like, yeah, okay, I've been thinking about doing this. Let's talk. And so 80-85% of the time they're going to get a response.
Okay. This is a great example. I like the theme of having some real strong will persistence behind all of this.
Yeah.
Because if you just send 1 or 2 and don't get a respond, you're not trying hard enough. We're going to push to get this first conversation going. And that conversation you mentioned, I'm going to rehash what I just sent along. That, hey, I see a fit here. Here's what I see you doing, something really cool. Here's where I see it fits together. Is it more of a bigger together story?
Yeah, well, and it's the flexibility point. You probably already know what their age is. You've probably figured it out. You might have been on their website. You may have seen a picture of them and About Us or researched their social media. It's like you can kind of decide whether they're young and potentially going to stick around or they're older and where retirement may be, more on their mind or their horizon. And so I'm tailoring a message, but the key is flexibility. And so if I'm seeing someone that may be close to retirement age, I might be thinking to myself, okay, I'm going to tailor my message a little bit towards, have you thought about your future? Have you thought about, when's the right time to sell the business? And I can be flexible in how that's structured. You could, potentially stay on. You could potentially be roll over a portion of your proceeds into my company and get a second payday. It could be that, you're looking, this is my brother and I sold our insurance agency. He ran for 15 years. He was 63 at the time. And when we sold it, it was 2020, January of 2020, right before COVID hit, we sold it. But my brother was like, I'm not ready to retire. I want to keep working 3 or 4 years. Great. Let's sell to a strategic who's going to keep the lights on and keep you employed and potentially let you roll over and get a second bite of the apple. And so, yeah, great. Great story. So we did that. So my brother sold the business. I got paid and cashed out because I was passive, but he got to roll over. And he sold to a really big company called Acrisure, who's buying like 100 insurance agencies a year, and they're going public next year. And so his rollover now is going to be a second bite of the apple during an IPO. But he's now 5 years down the road, or 4 years down the road. And so he's now 67. So he's announced to them his retirement. He's going to retire next May. Well, guess what? He's still got another 4 years, 5 years of income after selling, got the first bite at the sale, got the rollover, they're going public, he gets the second bite. It's like, so I think about that person and what the story might be and what might be helpful to them. Some say, I want to cash and go. Others say, I don't need a bunch of money. Clipping a coupon might be nice. So some seller financing might be a piece of this. Cash at close, give me a lump sum. Give me a 5-year note, a 10-year note at a 6-7% interest rate, whatever it is on a certain portion. Some would say, let me roll over and get a bite with you when you sell. I wasn't ready to sell. A younger person might say, I'm not going anywhere. I want to keep going. Great. Join me. Join me. Become a shareholder in my company.
So we are really pushing to learn their goals. What are their drivers?
Yes.
That's the key thing we want to learn. And then we get that level of interest of, hey, I have a process. I'm happy to sign an NDA. I get some numbers from you. I'm going to put a number. I get some financials from you. I'm going to put a number in front of you. And
if you like my number, we keep talking.
Exactly. Yeah. So if we go through that, we go through those steps. I'm curious about the structure part, because some of these deals, I think there's a big variable of what drivers are, but I feel like as the investor, acquirer, you're trying to keep cash. You want to be able to preserve your cash because you can do things with it. And then you have these different tools. There's debt. There's debt you can get through a third party. And now we have these cash-based lenders, funds out there. Then there's owner. You can have them hold a note and saying, hey, I got not all the money. I got to give you some money now, but hold some of this. There's rollover equity. You can say, hey, I'd like you to roll over, which gets the second bite of the apple. And then there's just some earnouts.
Yep.
I'd love to just get your philosophy and how do you think through that? How do you sort of
what my goal is, so I've got all these levers that you just mentioned, and I'm open to using a combination of all of them to get the deal financed. But what I'm really looking to use is other people's money whenever possible. So that's debt, or that's rollover equity, or that's seller note. And what I'm trying to design for is a 2-to-1 debt coverage ratio. So what the hell does that mean? Let's say I'm buying a company that has $500,000 in earnings, and that's cash earnings. Low capital expenditure. We followed my model. Then I want to use no more than $250,000 of the cash to service the debt. And so if the multiple the company trades for is higher than what $250,000 can service, I have a gap to bridge. Why do I want 2-to-1 debt coverage? Well, first of all, that gives me that's like 50% equity in the deal. Doesn't matter if it's equity from him, or her, the seller, or it's rollover, it's equity. If the company cycles down, if it loses 20% of its revenue, 30%, I'm not scrambling to find cash to pay the loan payment. I've got 2 times the debt coverage that I need. So I take the total cash flow, divide it by the amount of money I need to service the debt. I'm seeking a 2-to-1 ratio. SBA will let me finance a deal at like 1.2-to-1 with only 20-cent cushion. That's not enough, and although they'll finance it, I'm looking for 2-to-1. So what I'm really looking at is how much debt can I put on the company at a 2-to-1 debt coverage? And as interest rates are ticking down, that's a little bit more leverage now because interest rates are lower. That money will service a higher debt. And then whatever the gap is, I want to close that gap using seller note, using seller rollover, if possible. And generally I can. Generally, most of the kind of companies that I'm talking about buying, so again, remember I said fragmented industry. Fragmented industry because there's not enough buyers, it keeps the multiple I pay low when I'm buying the companies. And so generally between seller rollover or seller finance, seller note, and there's a thing called on standby. So a seller note on standby, it might be a 10-year note, but it's on standby for 2 years, the first 2 years. So there's no payment due during the first 2 years. An SBA lender will look at that and call it equity. It's not debt, and or rollover equity. Their equity becomes my equity. If I don't have enough money for a down payment, I've got equity because it's their equity now joining my company. And so combination of those plus the debt service coverage ratio sets me up for success in financing. And I know a lot of entrepreneurs out there think your problem is money. And that's because you don't understand money. You know plumbing, or you know roofing, or you know software, but you don't know money. And so there's trillions of dollars out there looking for stuff to invest in. You just have to treat money well. And so I have to structure it, and so I'm trying to solve for money. And there's a lot of people I can go to if you don't have this expertise, that we can work with. One buy-side advisor that I work with works with small business owners that do this. And his specialty power is he not only helps you get the company and get it under LOI and help you get through diligence, but he wants to get paid, which means he's got to help you get financed. And so he has a bunch of lenders that he works with and knows the creative ways that we can get a company financed. And he charges more of a success fee but he earns it. And so, there's, money is not your problem. Finding a good company and paying fair market value is what the problem is. But if you're trying to buy a company that trades in an industry that's 10 times,
that's what we're going to deal with in our software business here, Adam.
Then you're going to need equity. I can't not create it, or you're going to need a large rollover. So if you're a big company and they're a small software company, you may give them the 10 multiple, but they're rolling over 8 turns. You're going to get a lot less debt on it. In the grand scheme. And that has to do with the free cash flow. It has to be high free cash flow conversion because I need cash to service debt. If I buy
the cash flow, the
more debt you can service.
Better you can do that deal. That helps a lot of how you think of those levers and how to use them. And it sounds like it varies industry by industry depending on what your multipliers are.
It does. And so that's why I was saying in the beginning, it's like if we haven't picked an industry yet, use my framework and you'll be fine because you'll be dealing with companies and industries that trade at low enough multiples to where you can engineer this stuff. But there are industries out there that are high multiples. Software is a good example. Multiples can be really high because a software company may have no earnings, but they have great software and it's a good potential. And that's why you see these deals and you shake your head and scratch your head and you say, why did Google pay $1 billion for that? That made no money.
Yeah.
And those are the software unicorns, that are out there. So, some industries have higher valuations than others.
But that 2-to-1 debt ratios are.
That's kind of my key. That's what I'm trying to design for.
So you've done a lot of deals. How have you seen the process evolve? And everything that we're talking about is buyer-led at the end of the day. We're not waiting for a shiny deal to pop up and you jump on it.
No.
You've got a strategy we thought out, what we're doing, or approaching it. Now, when we talk about actually, you mentioned one of the flaws that new acquirers do is they don't do enough diligence. I'm curious of how do you see this process evolve as you do more deals? What I've seen is you become more buyer-led. You really start putting more effort to how you're going to integrate the company, how you're going to capture those synergies.
Yeah.
What's your view on it?
So, we can't just buy stuff. We have to be able to integrate it. Remember, we have to be able to demonstrate that we get more profitable as we get bigger. And so a piece of that is I acquire a company. During diligence, I'm mapping out the differences between how they do something and I do something. And it could start with 2 income statements side by side, line by line, going through and saying, what do they spend on advertising? What do I spend on advertising? What do they spend on this? What do I spend on this? And what do I think, is the art of the possible between them? And that creates the third column, which is either a positive synergy, a negative synergy, or no synergy. And I'm now kind of mapping out, what the differences are, which will drive my integration. But I need to get good at integration because, buying a good company is only half the battle. Integrating it and making it a productive part of your ecosystem is the back half. And if you're good at buying but not good at integrating, you're going to stall out and have nothing but chaos. If you're good at integrating but not buying, you're going to have chaos because you bought the wrong companies. It's like you have to get good on both sides of this. And if your volume is low, I tell you, if you're going to do a low volume of M&A, I can outsource this. Or I can hire a project manager, someone has got integration experience, and I can bring them in either part-time or full-time or contract basis to help me do a one-off integration. But if it's going to become a strategic part of your growth story, well, then I want to own the IP. I want to have a team of people that learn how to do M&A. I want them to learn and create muscle memory for my organization because I'll be able to leverage that over time to do more M&A and get better at it. And so I build my team over time. I told you, I hire a buy-side advisor. I start with an in-house, business development person. Well, a second resource I typically hire is a junior business development resource. Call it a spreadsheet jockey to work with my senior person. And it's a 2-person team. Third person's probably my first integration manager. Everybody's got a day job. I need someone whose sole job is to make sure companies I buy get seamlessly integrated and that things don't fall through the cracks. So there's a process, and after 4 or 5 years, I may go from no professionals in my company that do M&A to having 6 to 8 people in my business that do nothing but M&A. And this is and don't think you have to be big to do this. My first client when I left being a CEO had less than $2 million in EBITDA. And 3 short years later, we hired a VP of business development. We had buy-side advisors. We went out and got capital. I think they've finished 6 acquisitions so far, maybe one more, one less. He's now $15 million in EBITDA. We've now hired a banker. This company that was worth $14 million 3 years ago is worth $250, today. It's like, you can do this in a relatively short period of time. If he was growing organically, it'd take him 30 years to go from where he was to where he is. And so this is an acceleration of the story. Entrepreneurs, it's like, why can't it be you? It starts with you believing in yourself, and then recognizing that, hey, you know what? I don't know about you, but I have a lot of billionaire friends, and I like them, and they're smart people, but they're not God's gift to anything. So why were they so damn successful and we're not? Millionaires know how to make money. Billionaires went all in somewhere along the way, and stayed all in, until they found a higher level of success. But it's like, you look at an Elon Musk as an example, and I love Elon. He's like my hero because he's a guy, no matter what industry he starts, he finds massive success. You take a Bill Gates or somebody, also, brilliant and successful, but one-trick ponies are different than someone who's a serial entrepreneur, successful billionaire. Everything he starts turns into billions, right? So different animal. But when you talk to him, he doesn't come off as being the smartest guy on the planet. This is about working hard, understanding, having a vision, and digging in and making it happen. So you can make great things happen in your business. You just have to start by believing in yourself. Surround yourself with people who know a little bit about what you're trying to accomplish. Don't go alone and step in every pothole that's out there. Build a team of people. Use a process and then go for it. Stop talking, start doing.
The business fundamentals don't get away. You still got to work with the best people you can find. And then I think the other takeaway on the execution of all this is continuously get better at integrating, being able to capture value, increase margins, free cash flow.
And then your company builds muscle memory. And so M&A is a process. That's why I kept pointing out in my last 5-year run as a CEO, 1 company in the first year, 7 companies in the next 2 years, 15 in the next 2 years after that. It's like a pump on a farm in a well, and this is Texas, so wells are 800 feet down, and you're pumping that arm, and you're pumping until your arm falls off, and then the water starts coming. It's a process. It takes a while to build up deal flow, but once deal flow starts coming, once you learn how to do M&A and learn how to do diligence and integration, you get better at it. And as you're getting better at it, now all of a sudden you can do more of it. It's like a snowball rolling downhill. So be prepared for a slow start.
Yeah, that's like in any business as well.
Yeah.
I want to talk to you about exits.
Yeah.
In my mind of this conversation we're having, I'm thinking of the little fish, the cartoon where the little fish, then the big fish eats the little fish, and the bigger fish eats the little fish. And when we do these deals, like using rollover equity is a part of it. With that, hey, after the 5-year term, we're going to sell this business to the bigger fish. And then we get a good payout at a higher multiplier and get a good success story there. And then they run that same story again. Talk me through anything I can learn from you on that, because I feel like that's an area where I still have some reservations.
Yeah.
Using the deal room story, you built the business, and I get a lot of private equity firms. About every month I get about 5 to 7 that are inquiring, but I'm like, get to 20 million ARR, valuation is going to be a lot higher. Maybe we just wait till then. That's going to be a 2 to 3 year path. I want to challenge myself to change the thinking on this a little bit, Adam, of, hey, maybe, there's a different story. You don't have to sell your whole business where you just are left with a minority. Maybe you sell a minority piece and then later on you sell a majority. Talk me through how you think exits.
Yeah. So a couple things to unpack. Number one, you already said, if I get to a certain level, I get additional value. Where we exit, the size we are when we exit matters. And it's not just this continuum where I pick a spot and say it could be any number and it's going to be an upward trend. What I'm trying to say is there are natural exit points where you'll find a great deal of PE buyers. And if you understand the world of PE, you'll know that not all funds are the same size, and people focus on lower middle market, upper middle market, et cetera. And so based on fund size, all funds last for 10 years. All funds must deploy their capital within the first 6 years. They must, average hold period's 5 years. But they all invest 6 to 8% of their capital in one company. No more than 12, which means big funds don't buy small companies. Big funds buy big companies, little funds buy little companies. And it's created, with these dynamics, natural exit points. And so I'm going to lay out a few for you. Typical exit window really starts to open at $4 million of EBITDA, and it runs up to about 7. That's where your lowest, your lower level middle market PE firms start to buy and look for platform companies. Below that, people may call themselves a PE firm, and they may be registered as a PE firm, but they don't have traditional funds. It's two guys who made a lot of money at KKR, and then the friends and family, and they got like $50 million they're playing with, and they call themselves a PE fund. If your company is below $4 million in earnings, you're selling to either a strategic as an add-on, or you're going to sell as a platform to a sub-PE firm that is below kind of the threshold of where the first real firms that have funds with limited partners and raise traditional capital in a traditional manner. So 4 to 7 is the first exit. Next exit used to be 15, but it's come down. There's not enough good stuff to buy, and so every level's been flexing down a bit. People used to buy at 15, exit at 50. People used to buy at 4, exit at 15. Well, the people who buy at 15, not enough good companies to buy, they're now looking down at 10. And so I've got a pack of buyers kind of between 4 million and 7 million of EBITDA, another pack of buyers at about 10 million to 17 million of EBITDA, and then it jumps up. It jumps up to about 40 million in EBITDA. People that buy at 4 go to 15, exit. That's about how much they can grow a company in their typical 5-year hold period when they start at 4 million of EBITDA. They get up to about 15, they sell. People who buy at 15 go to 50. People who go to 50 then sell to someone who goes to 100. And then someone at 100 goes to 200, and then they go public. So there's these natural exit windows that exist. And you as an entrepreneur should have your eyes set at, I'm going to 4. I'm at 1, I'm going to 4. I'm at 2.5, 3, I'm going to go to 10. I'm at 10, I'm going, to 40 is a long journey, right? So, you're going to find pools of capital looking for stuff to buy at these natural exit points. And that's where I really see the multiple arbitrage happen. I get rewarded with, larger multiples being paid by people. So knowing where I'm building to is important. But then there's, who am I going to sell to? I have to learn how to pick a good partner from a bad partner. And no short way to say it, you're going to have to do diligence. You're going to have to talk to people who've been CEOs, who've sold companies. I want to talk to people they fired. I want to talk to people that are still there. And I want to learn what it's like to work with this PE firm, because they're all going to tell you how great they're going to be as a partner. And like any industry with 8,000 players in it, there's some good, some bad, some god-awful and some that are great. So I'm going to have to do diligence. But you mentioned something I want to touch on, minority versus majority. Mm-hmm. The majority of private equity capital is in what's known as a buyout fund. And a buyout fund, by its very charter, must buy a 51% controlling stake. They've told their limited partners, their investors, I'm going to control every company I invest in. And if you say, I want to be a minority, I want to sell a minority stake, you have just eliminated the largest pile of private equity capital on the planet. There's fewer minority investors, and therefore, there's also less money being paid. There's less competition, there's not as many of them, and they're not giving you the same multiple to buy a minority stake. There's a trade-off. So I would tell you, get comfortable thinking about life as a minority, shareholder. This is capital. They're not bringing a management team. If you're engaged, if you're working hard, if you pick the right partner, you're not gonna notice, a lot of negative aspects of working with private equity. They'll be a good partner. You'll actually enjoy having this capital and these people who can think through sophisticated financing. You'll never worry about capital again because they'll bring the capital and the debt relationships that you need to grow. Your focus will be solely on growth. And so, when I think of minority investing, it can be done, and I know some minority firms that are out there, but you're going to get typically lower valuations, and it's somewhat limiting. So for those of you out there who are concerned about being a minority shareholder, I say Elon Musk and Jeff Bezos. Jeff Bezos before the divorce. Two richest people on the planet both own less than 13% of their companies. And it's okay to be a minority shareholder. If you have the right partner, your focus is still on growing and running your business. They won't be as intrusive as you think. When we pick bad partners, or we pick the wrong partner, that's where it can go sideways. Or when we check out. I'm an entrepreneur who just sold my company. I got a ton of money and I'm not working very hard anymore. They want to win the championship this year. You just won a championship, but what you didn't do anything for them. They need you to work harder than you've ever worked before, using their capital, partnering with them, and you'll get a second bite of the apple. So I would tell you, if you want to do a minority, sale, you can. Those people are out there. You'll give up some equity. And it'll almost be like a mezzanine lender will give you debt, lets you do a kind of a little dividend recap, take some money out, some chips off, and they'll get a percentage of ownership and your company will service the debt. If you can't service the debt, well, then it has to be more equity. But there are people who will do minority. Don't get me wrong. I just think if I'm a seller, be a seller.
The control freak inside of me still got a counter argument for you, but I'll continue that over some drinks with you sometime. I think that could be a good long conversation and be a fun, challenging one. But you're absolutely right. I like how you explained that spectrum, and I think you're absolutely right that the majority of the market are buyout funds, and that's who's going to pay the highest multiplier. The minority, you got to really find the right one wisely and go from there.
And they'll have a minority rights agreement. You're not getting off scot-free. You're not making every decision, and they're going to have some control. So you're kind of got the same thing. You just switched who the majority shareholder was, but the dynamic is pretty similar.
The options are options. You got to weigh them. In terms of, I think the big thing I've been putting a lot of consideration in is the partners. I've heard of, it's like a marriage, right? You get a bad marriage, things could be awful. You get a great marriage, things are great. And that private equity partnership seems to be pretty symbolic of that. What your experience, I'm sure they all haven't been pretty. Well, maybe on record we all say they will be, but I know they haven't off record. What do you look for in really getting a good sense of what's going to be the good partner?
Well, there's hands-on, hands-off. A hands-on meter says, so let's say you're a transitioning Fortune 500 executive that's been recruited to go run a PE-backed company. In the Fortune 500 world, you lived in a hands-on environment. You had bosses who were crawling up your shorts every day. And so you're used to being micromanaged. And for you might actually be more comfortable in a hands-on environment. If you've been an entrepreneur calling your own shots, you're a cowboy and you can't put a saddle on, and no one's putting a saddle on you. You don't want a hands-on partner, a micromanager, and this is going to go bad south. It's going to go south quickly. You're looking for a firm that's more hands-off. And so I've worked with some firms that are hands-on and frustrated the living hell out of me. And there were times where we were cussing at each other and you're wondering, this divorce is imminent. And then we turn around and sell the company for a record payday and they give me a gold watch, and it's like, and we're the best buddies ever because we won. So there's the battle. And then there's the war stories that come later. And you know what? It's like, it's intense no matter how you slice and dice it. And then I've had other PE firms where I'm looking over my shoulder like, hello, is anybody home? Do I have an owner? Is somebody back there for me to talk to? Because they're so hands-off and disconnected. So there's kind of this spectrum. And this is called governance. It's like, how do they provide governance on their investments? What's the process? What's it look like? Is it going to be weekly calls? Am I going to have a framework that says every time I want to spend $50, I'm going to need some snot-nosed punk associate to sign off on it? Or am I going to be able to kind of run my company as I have been within parameters? And I understand, if I'm going to sell off major assets or buy something, big, I'm going to need, there's ordinary course and there's unusual and extraordinary course. And so I'm going to have different kind of rules. And so governance is something that an entrepreneur should spend time talking to the firm about. And again, this is like dating, and everybody's on their best behavior. And so I also tell people, if you're an entrepreneur, be on the lookout, because while you're negotiating a deal, this is a 4 to 6 month process to get through diligence and get all the paperwork done. And there's going to be some stress on the way. Somewhere during that time period, the real owner is going to peek out from behind the mask, in the fake arranged marriage mask, and you're going to see the ass. You're going to see the real person inside. And if the real person inside looks just like the one in the mask, you're fine. But if you see a personality that's like, well, that was a red flag, you probably just got a glimpse of what life in a stressful situation with your new partner might look like. So be on the lookout. Likewise, they're looking at you. How are you going to act when the negotiation gets tough or they're trying to reprice you?
How do I do my diligence? Should I be talking to other CEOs in their portfolio? What's the best way to do diligence?
I would ask them for references. I would ask them for references of portfolio companies that they've sold. So I'll talk to someone who went a full 5-year flip with them and had an outcome.
Full 5-year flip.
And then I'll say, I want to talk to some current founders who've sold to you. And I might even say, I want to talk to a founder that sold to you and you fired. And they'll be like, well, why would you want to do that? Because when there's a divorce, I want to understand how the divorce went.
Yeah.
Right? Divorces happen. I don't care the why. But I want to understand, so when we negotiate contracts and employment agreements and shareholder agreements, these are really prenups. These govern the divorce. And I want to know how people were treated when there was a divorce. And you know what? I could tell you, some people could call me and say, hey, Adam, you know what? Hey, I've been a long time in this game, and I've made a lot of money for a lot of people. But I've also been let go because we had a difference of opinion, and I moved from one company on to another. I made the first 2 buyers a crap load of money, and then the third one was frustrated. Well, they paid too much. Not my problem. It's their problem. But at the end of the day, it's like, or something went south. But you know what? I can tell you, that there are firms out there who, if there's a divorce, they treat people well. They treat people fairly. It's like, hey, we were good people heading into it, and we're good people coming out of it. And so talking to people who went the full trip, talking to people who sold and were let go, talking to people who are there now, you'd be surprised. These people don't just sell a company line. An entrepreneur will tell an entrepreneur what they think.
What point in time do you do that level of diligence? Is it
after LOI, before the close?
Okay, between LOI and close.
Yeah, cool. If you're the seller. You're the seller. Yeah. Now, if you've built a company and you've hired an investment bank and you have 30 probable buyers in a process, you can't do that level of diligence on 30 buyers, but you can start looking at the kinds of companies they own, or start trying to figure out if you can gather some intelligence just about what kind of buyers are out there. But very quickly, you'll see as bids are coming in or refresh bids are coming in, it's like 30 becomes 5. Well, I can start doing a little bit more homework on 5. I might look at companies that they bought. I might know somebody who ran one or built one, or but at any rate, when it's somewhere before the close, I need to figure out that this is a partner that I can work with, because you'll never have more control than you have in the first sale. The first sale, you can say yes or no, and it's not just about money. We want market clearing price, but you can also be choosy on buyer. But once you're sold and in that ecosystem, the PE firm is likely going with the high buyer next time. And you can guide that as the CEO somewhat, and still have the ability to pick a partner, because you can decide not to stay or to stay. And so there's always some ability to control, but there's multiple parties at the table, and so we need to do diligence.
We can keep going. And I've just looked down and realized we have not been using our outline.
Well, that's why we keep getting back together. So we'll have to do another one of these because I unfortunately am 25 minutes late for my next meeting.
Hey, before we wrap up, all I got to ask you, what's the craziest thing you've seen in M&A?
The craziest thing I've seen in M&A, there's been times where I have seen just crazy valuations, and I'm talking, like I would say, you're in the software world. My son's in the software world. He's a CTO of a software company owned by a large PE firm, and I look at the multiples that get paid, and it's crazy. It's crazy. The math sometimes gets crazy, and you think, how can this even possibly be? And you know what? It's funny, though, because Mitt Romney is quoted as saying, I don't know if it's true or just a wives' tale, but he's quoted as saying in the 1980s, there's a bubble coming in the world of private equity, and someday it's going to burst. And so, but yet 40 years, 50 years later, instead of hundreds of billions in asset under management, I just read something yesterday at McKinsey. McKinsey put something out yesterday that said that there's over 7 trillion in assets under management right now in private equity. 7 trillion. When I wrote the first PE playbook, it was 2.83. When I wrote the second PE playbook, it was 6. And now it's 7, less a year from the time it hit 6. It's like the money just keeps on pouring in. The money has to be put to work. I don't know what to tell you. Craziest thing I've ever seen. Some people pay crazy multiples for company, and you wonder how could they ever make this pencil? How do they ever grow it? And sometimes they do, and sometimes they don't. But haven't seen anything too unusual. But
I have to agree with you. I think from my career in the days I did M&A till now, it was EBITDA was a standard, not top line revenue.
Yeah.
So.
And the multiples being paid seem to keep creeping up. They poked down a little bit here with the high interest rate environment, but now the interest rates are ticking down, and multiples are starting to creep back up. So I don't know. It's a great time to be an entrepreneur with a company to sell. That's all I have to say.
Valuations are crazy.
They are.
Adam, thank you so much for taking the time to have this conversation. You've helped me become a better M&A scientist. Those of you still listening, fellow M&A scientists, I commend you.
Yes.
And Adam and I will both personally congratulate you. Reach out to both of us on LinkedIn. I know you're a pretty active networker as well.
Yep.
As well, I always welcome ideas, criticism, so I can continue getting better at doing this and create more value for you. Till next time, here's to the deal.
Thanks, everybody.